Hello, everybody. Good morning, good afternoon, or perhaps even good evening. Welcome to Tungsten Automation's Global Invoice Compliance Update and the Impact of ViDA webinar today. First of all, for those of you who joined today, thank you for joining, and a copy of the recording will be made available afterwards. And also, I encourage you to ask questions throughout the session, and we will seek to answer these questions afterwards or straight after the session. And if we can't do all the questions during the session, we'll follow up later. So again, thank you very much for joining. I am Ruth Van Hilton. I work for Tungsten Automation. I am the director of Invoice and Compliance in Tungsten, which means I have at the moment one of the most riveting jobs in the world. At least that's what I think. So what are we going to be talking about today? Today, we'll first talk about just what's going on, what's happening out there with global mandates, with ViDA, VAT in the digital age, and then going into some of the key trends and what we call the great reversal, where the truth is in the transactions. That's what the agenda says, and I'll explain what I mean with that when we get to those slides. We will then do a list of a number of countries where we do some deep dives, not very deep, otherwise this session would last for around about 2.5 to 3 hours, which I'd love to do, but of course you have other things to do through the day. And then at the end, we'll give you some key takeaways. How as a business you should be looking at these challenges and how you should be looking at addressing these challenges. Now, let's first briefly talk about ViDA. VAT in the digital age. It's a European directive to begin with, so it's basically European law, if you wish. It was agreed on the 11th of March of this year, so 2025, and it was published on the 25th. And you will see that actually some of the provisions in ViDA have already begun to have an effect in 2025. ViDA is an attempt of the European Union to modernize and harmonize VAT with the purpose of stemming fraud, better tax collection, and also to simplify processes, something that I know the European Commission is always looking for. And it builds on 3 main pillars. The pillar of the single VAT registration. Today, if you are doing business in multiple countries in Europe, you will have to have multiple VAT registrations in these countries, which is costly, time-consuming. The other pillar of ViDA is the platform economy. Today, or until ViDA has been agreed, it wasn't entirely clear who's liable to pay VAT in a platform environment, specifically for hospitality and transportation services. Who pays the VAT? Is it the platform? Is it the agent? And that has been clarified in the ViDA Directive. But the most important one for today is the digital reporting requirements, which standardizes electronic invoicing and reporting requirements across the entirety of the European Union. And that is a very impactful pillar, and I will take you through that pillar right now. So if you look at ViDA is not just one event, it's a series of events that will happen over the next literally decade. So you'll look at this and go like, well, the digital reporting requirements we just spoke about is not until July 2030, so I don't really need to worry about that. But what's going to happen in 2030 already has an impact on today. And actually, I said earlier that the ViDA package was ratified in 2025, and some of the provisions in the ViDA directive already are effective today. For instance, the abolition of EU derogations. What does that mean? It basically means that individual member states in Europe do not need to ask for permission for mandatory electronic, domestic mandatory electronic invoicing. So if a country is looking at implementing electronic invoicing in their country, they do not need to ask for permission. The other thing that has been removed from the VAT directive, actually, the VAT directive, is the buyer consent for electronic invoices. So under the VAT directive, a buyer needed to agree to receive electronic invoices. That's been moved out, and you see effects of that almost straight away. And actually, one of the countries where that effect has been visible has been Germany. There's multiple deliverables over the next few years. For instance, the single VAT registration becomes reality in January 2027, not really too far away. And just shy of a year later, the VAT obligation on the platforms becomes a reality, and then it's very clear about who needs to pay the VAT. And as I said earlier, the digital reporting requirements come into effect in July 2030. Yes, it's still 5 years away, but if you look at what needs to happen, I assure you that your government is already looking at this today, because they know there's a lot they need to change. And also from the European Commission, there's still quite a lot of clarification that needs to be provided. You see another date, 2035, that's where the countries like Italy, Poland, and Romania need to retroactively align their mandates, their e-invoicing obligations, with ViDA. They don't exactly fully comply with ViDA, and they have until 2035 to actually then retrofit themselves with those requirements from the ViDA environment. So it's quite a bit to happen. And then if you look at the on the impact of derogations, as I said earlier, that's a request for the VAT Directive to not to apply when a country asks for the approval to implement a domestic mandate in their country. For those of you who are tax geeks like me, those are Articles 218 and Article 232 of the VAT Directive that basically says that if you want to prefer or mandate the use of electronic invoices over paper and PDF invoices, you're not just allowed to do that. So you need approval, you need literally permission of the European Union to do so. Now that obstacle that has been removed, which means that from the 1st of January 2025, any country in Europe can just implement a domestic e-invoicing obligation on their upon their constituencies as they see fit when they want. However, Europe has laid down at least two very important conditions to do so. First of all, it is not allowed to extend the local domestic mandate to include VAT registered companies from other member states. So if there's just a VAT registration and no permanent establishment, it's not allowed to include such businesses. And the other one is that the taxable transaction must be actually taxable in the territory of the member state concerned. There's some other provisions, for instance, that you can't deploy hard clearance, where the government actually validates invoices and can actually reject these. That's seen as a trade barrier, and that is also sort of out of scope. So it's not like it's now complete liberty for member states to do as they please, but there are rules, but it has become quite a bit easier for member states to implement electronic invoices as an obligation in their countries. Now, if we look at the digital reporting requirements, the ones I said earlier is the most impactful, it basically means that every cross-border invoice, so actually, and it's intercommunity invoices between two member states in the European Union, must be reported in near real time to the tax authorities of those countries, both by the buyer and by the supplier, so both by the issuer as well as by the receiver. The invoice thereby also needs to be electronic. So the cross-border invoice, the intra-community invoice, must be electronic between these two businesses in the member states. That basically means that because it needs to be done in near real time and it's invoice by invoice, so every invoice is actually reported, you move from periodic reporting to transactional reporting. So it's no longer a periodic report, it just sends once a month or every quarter. It's actually every invoice is immediately reported to the tax authority. And the tax authority reports these invoices into a central database, also known as the extended VIS. This is a very impactful measure because it means that any invoice going from one member state to another must A, be electronic, B, be reported by both the buyer and the supplier in these countries. And that raises a good number of very fundamental questions. What exactly are these requirements for e-reporting, and how does that work, for instance, for hybrid invoices? I've just taken a few of the questions that people raise to me as somebody who's quite involved in ViDA and is quite close to the developments. How about hybrid invoices that, for instance, exist in Germany and in France, the Facture X, as well as the X-Rechnung, the Zoekveld? How do these then play in countries where in another country that is not a known standard? What is the transmission method of the invoice between these two member states? Is that regulated in any way? Is that unregulated, which is also a problem? So what exactly are we looking at? And does this mean that a member state in Europe is actually better off by also mandating a domestic DRR? So we're also mandating a domestic obligation for electronic invoices, or are they fine not doing that, which would cause a situation where intercommunity invoices must be electronic, and at the same time invoices domestically are perhaps not electronic, which is extremely difficult for businesses to adhere to. And of course, you could say that for people in my world, in my space, we are an invoicing provider. We are very engaged in invoice automation. That's our bread and butter. Doesn't this mean that the government is doing your work, in a sense, and doing your marketing by making electronic invoicing an obligation? And my answer will be yes, but also it is an opportunity. But how do you translate that opportunity into real business value? Well, first, before we go into that, let's quickly look at what do all these things mean on a fairly high level. Well, one of the most important elements is that we are moving from a situation where invoices are reported to the government. We are moving from a situation where it is no longer down to the interpretation, the subjective interpretation of a business when they report their VAT returns or, for instance, their sales listings, which they do once a month, once a quarter. It's actually now completely automated and is no longer an interpretation. It is objective, because we need to realize that the government sees every invoice, sometimes even before it is submitted to the buyer. And that gives government significant capabilities they didn't have before. For instance, a suspicious invoice can be spotted right away in real time, which can trigger a spot audit. A tax authority sees a specific transaction that it has a suspicious nature, and they can act immediately. It's something that they couldn't do before, because before they were, of course, completely dependent on the audit and the samples that they would take. Another capability that governments are building for themselves this way, by seeing all this transactional data, is the pre-filled tax returns. The ability for a government to proactively tell you how much money you owe them or they owe you before you even report this. And that means that you need to have your data in very, very good order in order to be able to defend yourself in case you don't agree with the pre-filled return. That is really, really important. So let's look a little bit further what all of this means in terms of countries, for instance. Well, if you look just a few years back, not too far, 2022, we could see a trend emerge, and that trend had actually been going on under the waterline for quite a while. That more and more countries were moving into what we call a mandate, or were moving into a CTC, a continuous transaction or tax control, over time. And what we believe, because of the normal market forces of competitiveness, of just like the technological capabilities, what we are now seeing is that more countries are following. And actually, what we now believe is that by 2030, which is not really too far away, is that the majority, if not all countries in the world, will have adopted a clearance or some sort of a CTC model. It means that the government is actively involved in the financial transaction between businesses. It may not be exactly like this picture. Of course, it's a bit of a crystal ball, but it is an unstoppable, unavoidable development and evolution in the market. This is not going to go away, and something that we are going to be dealing with for the very foreseeable future, for the next 5 to 10 years. And then, of course, there will be countries that may not adopt a system like this, but I believe, and we believe, and with us, many consultancy and market analysts agree that this is probably the key evolution that we will see in the world of invoice automation and invoice submission. And actually, if you look at the direction of travel for the very foreseeable future, between now and say 2027, 2028, this is exactly what we are seeing. You are now seeing a list of all countries that are planning to, or have just, or are in the midst of implementing an e-invoicing obligation in their countries. And this is actually, frankly, a pretty scary list. This is a lot of countries globally that all move to electronic invoicing as an obligation in their countries. So if you look at this list and you find yourself doing business in a number of these countries, you actually know that you are going to get disrupted and you are going to get distracted because you have to do something. Compliance is existential. You cannot not comply. So this is something that you must pay attention to, and the sooner the better. Now, from a perspective, and also the key topic of today is a bit of a window on 18 months looking into the future, a bit shorter. And what we have done, we've plotted a number of countries together. You see them here from Belgium all the way to France and everything in the middle. It's not a complete global view. This is not exhaustive. It didn't fit on one page. But what this picture is here to show is that every country goes about this in their own way. No two countries implement exactly the same mandate. They don't. They are very different, sometimes just slightly different, but they're always different enough to be completely different projects. And that's something that we need to bear in mind. No two mandates are ever the same. Now, what we have done for you is that for each country, we've built a little sheet that tells you sort of like the ins and outs of these countries. And I'm going to focus very specifically on the model, what's in scope, and some of these salient details that you need to be aware of, because the models are very different and also very important, because to an extent they determine how invoices need to be distributed, how invoices need to be transmitted. So Belgium goes live on the 1st of January 2026, literally just over a month to go, with a four-corner model. Why is it called four-corner? Four-corner means that the supplier, then also a provider to the buyer, and the buyer themselves are each a corner. The supplier is corner 1, their provider is corner 2, the provider to the buyer is corner 3, and the buyer themselves are corner 4. That's why it's called a four-corner model. And the idea is that between the two providers, so the provider to the supplier and the supplier to the buyer, a standardized format is exchanged. In this particular case, PEPL. So there's a PEPL mandate in Belgium. You can actually step away from it, or as people call it, opt out. And that basically means that you need to bilaterally agree with your supplier and your buyer that you can use another format, and that format then needs to be interoperable or compliant with the European norm. But you still, even if you do that, you still have to have PEPL capabilities. So even if you decide to not use PEPL, you're still on the hook. You have to do PEPL somehow. Not in scope are transactions that are cross-border, consumer transactions, anything that is excluded by law. And as you can see, in scope are VAT-registered established businesses. As I said earlier, this is exactly what ViDA set out, that company, that businesses, and also their governments need to do. A salient detail here is that when you register your entity, your receiving entity, into the Belgian phone book, also known as the SNP, you don't do that with your VAT registration number. You do that with your KBO number. KBO number is also known as the Kruispuntbank van Ondernemingen. I'm Dutch. I can pronounce these things. It's a different number. You just need to be aware of that. There are some other rules for B2G invoicing, but as you can see, it's a fairly straightforward. Mandate obligation. It's a PEPL, very vanilla PEPL four-corner model. Does it mean it's really straightforward and simple? No, it never is. There are always specific exceptions and specific working methods that you need to adhere to. So that's Belgium. But if you then look at another country that goes live in January 1st, 2026, there's Croatia. And Croatia is also using a four-corner model, like Belgium, but just different because there's also a CTC component, or what we call a continuous tax or a transaction control component. It means that both the buyer and the supplier report data to the tax authority in the country. That reporting of data in Croatia is called fiscalization. Now, both parties need to literally report the transaction they send or receive to the Porezna Uprava, the tax authority in the country. And then as you process your invoice and you do your 2- and 3-way match, and you find that perhaps the invoice does not really cover the supply, then you may end up rejecting your invoice, which would then mean that you need to report that rejection also to the government within a month. Here, the legal invoice is also the European norm invoice, according to the Croatian SIAS. That basically means that Croatia has its own definition of the European norm. And then also there's a very specific digital signature required on the communication to the government. It's an EIDAS signature. It's a very specific advanced signature. But in contrast to Belgium, Croatia does not mandate PEPL, does not say that the distribution needs to be going through a specific system or through a specific network, even though they strongly prefer the AS4 network to do that. But they say there are other possibilities that you need to, or that you can use. The other salient point about Croatia is that almost simultaneous to the implementation of the invoicing obligations, they've also implemented a product and services classification system known as KBD. So it's not a very not a very relaxed environment, if you wish. There's a lot people need to do in Croatia. It's a very complex mandate. Another difference with Belgium is that Belgium has taken well over a year to familiarize their businesses, the business in their country, their taxpayers with their plans. Croatia has really not given us that much time. It's actually quite a bit short. It's just a few months, and that sometimes happens. Again, as ViDA allows basically allows countries to just do this. Moving on, and a completely different country is Poland, also within the European Union, but using a completely different model, and actually not even using the European norm for invoices. In Poland, the legal invoice is an FA3. That's an XML based on SAFT. It's not based on the European norm. That's a fairly stringent deviation. This is, by the way, one of the reasons why Poland needs to somehow retrospectively converge itself into the ViDA arrangement by 2035. But if you look at the picture here of the model here, it looks very simple. It basically means that the supplier submits invoices into a central platform called KSEF, and buyer needs to get that invoice from KSEF. It's a central distribution environment where the government plays a very central part to both the submission as well as the release or the receipt of invoices in the country. So every invoice needs to pass through the KSEF platform. But if you look at the scope in Poland, there is another thing that is striking, is that cross-border purchase invoices are not in scope, but cross-border sales invoices are in scope. It means that if you're a Polish supplier and you sell goods or services outside the country, you actually need to also report those transactions to the KSEF platform. It doesn't mean that your invoice needs to be electronic when it goes to the foreign buyer, because of course the foreign buyer doesn't know how to process an FA3 invoice, but you do need to report that invoice to the KSEF platform in the right FA3 format. Also, getting access to the KSEF platform isn't really that simple. It's a fairly complex invoice, and there are multiple document types that you need to be aware of. And if that's not enough complexity, Poland also has some fairly complex offline mode provisions, which means that, for instance, if for some reason the KSEF platform is not available because of maintenance, perhaps because of a defect or something else, you can raise invoices outside the KSEF platform, but you need to report those within a certain period of time, and that's where QR code provisions start coming into place. It's not really a very easy environment, even though if you look at the picture, you would say, well, that's fairly simple to do, but it actually is not. And again, a completely different model from what we saw earlier in Belgium and also in Croatia. Now, Poland is one of these countries that has also taken a lot of time to familiarize its taxpayers with the plans, the setups. However, Poland made very fundamental changes just a few months ago, and actually still just a few weeks ago, that caused quite considerable rework on those companies that were already ready to transact in the country, which again shows that it is never a stable, static environment. It's always extremely, I would say, extremely volatile, if you wish. Let's leave Europe for a second. And let's look at UAE. UAE goes live a bit later. It's a year, more than a year from now in 2027, but you can already voluntarily use their system in 2026 from July. Again, the UAE model is different from what we saw in Poland, Croatia, or in Belgium. It is based on PEPL. It's not really a PEPL mandate. It is based on PEPL, strongly based on PEPL, and it's a five-corner model. It basically means that here the government is also a PEPL receiver. The legal invoice in UAE is a PEPL file. However, it's a different PEPL file from Belgium, for instance. It's not a PEPL BIS file like you see in Europe. It's a PEPL PINT file, which is a PEPL international standard file. And then, according to the specifications in the UAE, so the PEPL PINT AE is the legal invoice in the country. There's a lot of messages that need to go up and down between every single player, within every single party in this model, in this five-corner model. There's a lot of message level status information that needs to be exchanged between all the parties. That's one striking element. The other striking element is that businesses in scope is anybody with a VAT registration in the country. So not just established organizations, but everybody with a VAT registration. That is important, and they can do that because they simply are not in Europe. Another salient point is that cross-border invoices also need to be reported to or through the PEPL infrastructure. And last but not least, exempt and zero-rated transactions where there is no tax on the invoice also need to be reported to the UAE government and need to flow through the PEPL transaction environment, because or actually in the form of a commercial invoice. As I said earlier, they don't start until January 2027. You can voluntarily join earlier, and by the 1st of July 2027, or actually the 31st of July 2026, you need to declare who your service provider will be. And what is salient in the country is that you can only use one provider for both inbound and outbound transaction. And that is very different from what PEPL or how PEPL works in other countries, where you can use a completely different provider for outbound transactions from the one you use for inbound transactions. In UAE, they need to be exactly the same. I'm going back to Europe and I'm going into Greece. I'm going to speed up a bit. And Greece is a country that is going to build upon its implementation of the MyData platform a few years ago, which is an e-reporting environment, and now extending it into e-invoicing requirements. A different model, as you can see, is called the clearance model, whereby the Greek government wants to see every invoice before the final invoice is created and can be shared with the buyer. The buyer does not need to use a specific ASP, like an accredited service provider. The buyer doesn't have to do that, but the supplier must use an accredited service provider. That's really important, that they have to do that. That accredited service provider must report the invoice to the MyData platform. In return for that, the platform gives you a mark, which is also known as a UUID, a unique identifier for the invoice, and also a QR code, and that QR code must be mentioned on the invoice. The invoice is, contrary to today, will move to a European norm invoice. So the invoice must be European norm compliant, which means it by nature, it is structured. And because there is no need for a let's say a party as an ASP or an accredited service provider on the side of the buyer will need to tell the supplier or their provider how they want to receive these invoices. So actually there's no regulated transmission of invoices. The invoices must be in a specific format, European norm, but how these invoices are sent to the buyer is not regulated. Now, over time, Greece will grow into a five-corner model whereby both parties do use an ASP, an accredited provider, but for the moment, that is not necessarily a requirement. So we're looking at an evolving mandate over time. This goes live on the 2nd of February, 2026. You have until the 31st of March to completely transition over, so double let's say double issuance or let's say double ways of working are allowed in the beginning. But of course, from March, you need to be fully on board, fully ready and transacting as required by the Greek government. Another important point is that if you do business from Greece as a Greek supplier with buyers outside the European Union, you need to report these invoices as well to the My Data platform. So you'll need to find a way to distinguish for yourself what's inside the European Union, what's outside the European Union as third countries. Those need to be reported separately. So again, completely different model, different transmission, different file format, different provisions of what's in and out of scope. Now, briefly over to Germany. I've actually depicted Germany slightly differently because Germany is sort of in flight already. And I wanted to show Germany slightly differently because my intent with this slide is slightly different because it shows you how governments and countries evolve over time. So Germany went live with a version of a mandate, I call it a halfway house, on the 1st of January 2025, so about 11 months ago. And what they went live with was a requirement that if a supplier in the country sends an electronic invoice that is compliant with the European norms, so EN 16931, the buyer must accept that invoice. Doesn't mean they need to pay it, but they need to accept the format. What wasn't regulated in Germany, though, is the transmission. So how does that invoice get to the buyer? Is that through email? Is that through PEPL? Is that through EDI? Any way that could be done. And actually, that is a bit of a pain, for lack of a better word. That's disruptive. If anything gets in the way of automation, it is submission of invoices via email. It's just not very helpful. So today we have an obligation to receive, but from the 1st of January 2027, not too far away, we have an obligation to issue. It means that suppliers in the country must issue electronic norm invoices, European norm invoices. That counts for or holds for taxpayers with revenues in excess of 800,000 euros, which is pretty much any country in Germany. EDI doesn't have to comply. Germany is a manufacturing production country. There's a lot of EDI in the country, and by the 1st of January 2027, EDI does not yet have to comply, does not have to be interoperable with the European norm yet, but the transmission is still not regulated. It means that we are still going to be dealing with a lot of email. Even though there is a PEPL environment that could be used, we know that the German government has been actively endorsing the use of email in the country. If we then look at January 1st, 2028, that is when the German government will be implementing e-reporting. They will then implement a government entity, a government platform, where probably both the buyer and the supplier need to report invoice data into. That's also when EDI needs to be interoperable with the European norm. So EDI has until January 2028 before they need to be fully compliant with the European norm in the country, and then all taxpayers, VAT registered and established in line with ViDA, need to be on board, need to be following the invoicing obligations. So that's a country in flux. Started relatively simple, with then the additional comment that it's painfully inadequate to just use email, but we are where we are in Germany, and we're following, of course, very closely the developments in Germany as they move along. 2 more countries to go. Very brief: Brazil and France. First, Brazil. I use Brazil as an example of a very mature mandate that has been there for years, for more than a decade, actually quite a bit longer. Known as one of the most complex tax environments, or at least VAT environments in the world, with many different types of invoices, NFE, NFCOM, NFSE, depending on what kind of transaction it is, for consumer, whether it is a goods transaction or for services or for energy or perhaps telecommunications. These all have their own invoice type. Also, distribution of invoices in Brazil depends on whether it's a good invoice or a services invoice. Goods invoices move through CEFAS, which are the regional local tax offices, whereas services invoices pass through what we call city halls or municipalities, of which there are about 5,000 in the country. a very different distribution model. Now, Brazil is moving into a completely different model in a sense. First of all, they're moving from origin-based taxation, so taxation based on where the invoice comes from, to destination-based taxation, i.e. information where the invoice goes to, taxation where it goes to. So actually that means, as a taxpayer in Brazil, that before you release an invoice into the network that is the Brazilian tax environment, you need to be really sure that that invoice is correct, or else you'll be facing quite a bit of trouble. So you have to make sure that the invoice is very compliant, because it's going to be very difficult to do anything about it if it's not. The other part of the regulation change in Brazil means that Brazil will be implementing hundreds of new fields across all these different invoice types they have in the country, but also hundreds of new validation rules. And it stipulates again how the Brazilian government looks at, for instance, debit notes and credit notes. They don't see them as business transactions, but they are seeing them as situations in which the issuer changes the tax that is due. That's a very specific way of looking at trade documents. It's very important to remember that. Now, also, everybody would recognize that for the NFSC, the services invoices in Brazil, that's extremely painful through all these different city halls. Every city hall has its own capabilities. Some of them are very modern, very well, let's say, IT equipped, offer APIs. Others just still force logins or distribute PDF invoices via email. It's a very diverse landscape, extremely difficult to work with. So therefore, the central government is implementing what they call a central municipality or central city hall, to which other city halls, small city halls, can connect or even converge into. There's no obligation for them to do so, and the take-up is still very low. It means that we will see local municipalities persist. It's really important to understand that, because large municipalities or city halls, like for instance Sao Paulo or Belo Horizonte, will continue to do what they are doing today. So that landscape will probably remain. I'll close off Brazil with saying that there are also 13 new reportable events that originate from different players in the chain, either the supplier or the buyer or both, or even what we call a successor or even a tax authority. These are reportable events, for instance, as the reduction in a value of the goods because of perishment. There are many of these different events that really need to be observed. So if you're doing business in Brazil and you haven't really looked at this yet, I strongly urge you to do so. It starts on January 1st, 2026. It's extremely complex. And if you haven't started yet, again, as I said, you really have to. Large country for me to go on is France. And again, not to show you what needs to be done in France per se, but rather than how a country can be in flux, even if they ramp up to go into their mandate, which starts in September 2026, about 10, 11 months from today. Still looks like a long way, but the French mandate is extremely complex. It forces e-invoicing, it forces e-reporting, it forces continuous updating of invoice statuses, both with the buyer and supplier and the government. And depending on how you're registered for VAT, it also forces a declaration of payment status when invoices have been paid. Not a simple platform at all. And just about a few weeks ago, the French government released a number of simplifications and relaxations of what is in scope and not in scope, specifically for specific type of companies, whether they are established or not established in the country, to do with e-reporting, what you need to report, don't need to report. I think many of these simplifications and relaxations are actually quite welcome, but it shows that as they ramp up towards their mandate and testing, and when the government platforms become available, countries are still making fundamental changes, which make it really difficult to work with. About a year ago, the French government decided to no longer and completely abandon the idea of the central platform, the PPF, that has completely gone away, reducing or completely eliminating the idea for small and medium enterprises to use a free government platform, forcing everybody to use accredited providers, for instance. These are very dramatic shifts in the run-up to a mandate, and this is also fairly dramatic, even though not as large as the abandonment of the PPF, of the public platform. Now, what I've been trying to show you is three different things, is that no two countries implement mandates or CTC or e-invoicing obligations in the same way. They are all different in model, in what makes the legal invoice, how invoices need to be submitted and received, what information needs to be released to the government. They're all different. That's one. The second one is that once a platform, once a mandate is live, the government continues to make changes. They do, and sometimes these changes are very draconic. The third one is that in the run-up to the implementation of an e-invoicing obligation, of a CTC, the government also makes changes in scope, in their understanding, in capabilities, which is difficult to deal with. And altogether, that leads to, I think, this situation. For lack of a better word, it's a bit messy. If you do business in multiple parts of the world, in Asia Pacific, in Latin America, in Europe, also in Africa or in the Middle East, you will see changes in how governments look at VAT settlement, how invoices need to be distributed. Now, for some of you who are old enough, like me, to recognize this picture, I'm not from Sweden, but this is a picture that shows the relative chaos on the day that Sweden changed the direction of traffic, which was done in 1969 on a September day, and this is what it led to. What we need to realize is that the Swedish government took 2 whole years to familiarize the public with that change. 2 whole years. And in many changes in VAT reforms, we don't have 2 years. We're not given 2 years. And even if we have 2 years, the government makes many changes along the way. So in a way, if we don't structure ourselves around best practices, around doing this the right way, around the key challenge of how do I avoid disruption, how do I avoid disturbance to my business, if you don't structure that, this is what you are on the way to. This is what will happen. So what does that look like if you look at it in a slightly different, more organized manner? It basically means that as a business, you are stuck between yourself and the government. You're stuck between what each and every single one of these governments want in terms of, as I said before, invoice format. What makes the legal invoice? How is that invoice going to be distributed to both the recipient and the government? What format is that invoice in? What needs to be reported to the government? And when you receive the invoice, again, what do you need to report back to the government? What format are you receiving that invoice in? And which way are you receiving these invoices? And the supplier and the buyer requirements and their obligations are different. That makes things even easier. This is a very difficult picture to solve, and it will lead to the former picture I showed about the chaos in Sweden, unless and until you look at it fairly differently, where you implement a single platform, if you wish, a single platform between yourselves and the government, so that no longer you need to worry about how the invoice gets to the government and how the invoice gets to the buyer, or when you receive invoices, what needs to be reported to the government, whether a digital signature is required, what information needs to be passed on back on to, for instance, also the supplier, and if they work with a provider, how you approach that provider. None of that really should be your worry. It should be the worry of that platform in the middle. And Tungsten Automation offers that platform. It's called Invoice Agility, and that Invoice Agility platform deals with all these idiosyncrasies, with all that variation and diversity of format, of connection, distribution, and reporting on your behalf. And it has one characteristic that is absolutely key, and that is simply the ability to receive and send any invoice in any format, regardless of where it needs to go to or where it comes from. Whether it's a physical PDF or paper invoice, whether it's a typical e-invoice, whether the invoice comes from or needs to go to a government platform, where there is a PEPL platform, a PEPL network in place, or another network like AS4, or for instance, if the invoice is received from another provider in an interoperability environment, or in countries that haven't gone down the path of, let's say, sophistication yet, email. You also need to be able to deal with email. And there's always cross-border invoices as well that need to be sent out in the traditional manner, at the very least until 2030, until that needs to be electronic too. And this platform, Invoice Agility, helps you today with dealing with the diversity and all these different implementations in all these countries, avoiding disruption, but also in the future. In that sense, it is completely future-proof. Invoice Agility, remember that name. Now, so far, I've been speaking about compliance. And a compliance, of course, is existential. If you don't comply, you don't exist. It's really, really simple. But I don't know of any company that just exists to comply. These companies don't exist really. Your company, every company exists to create value for itself, for its shareholders, definitely for its customers, its staff, its partners, for everybody in the chain. That's why businesses exist. They don't exist to comply. Comply is something that you simply must do. So every company I know is somewhere on this journey you see on screen, where in a journey to create value, to drive agility, to be a better business. Because if you don't become a better business, and if you can't compete better, you can't exist. You can't survive, basically. So you can't exist if you're not compliant. You can't survive if you can't compete. Now, how do you make sure that all these developments, with all these governments in the middle, trying to, in a way, they're not trying to disrupt you. They're trying to do what's good for their country. I'm not saying that the governments are bad. They're trying to implement structure. They're trying to implement improvement. But those improvements are not necessarily good for you as a business, in the sense that what is good for government isn't necessarily good for business. And what I mean with that is that if an invoice is completely compliant in the eyes of a government, it may be completely useless in your AP or in your AR environment. It just doesn't do what it needs to do. It doesn't help you automate. That means that as an automation company like ourselves, you need to have a lot of capability: AP, AR, reporting, e-reporting, transactional reporting, periodic, but also then filing and analytics. And we realize, and I hope every single one of you realizes, that there is no single company that can do it all. That will be a unicorn, and a unicorn is a fairy animal. They don't really exist. So I know that there are many companies out there that only talk to you about compliance. And I'm telling you here that that's simply not enough. It's not good enough. They need to talk to you about competitiveness, using that compliance challenge to also automate and improve. But how do you do that if you don't want to work with a unicorn? Because unicorns, as I said earlier, don't exist. And that's what we do with our partner Sophos. We have realized very early on that even though we are really, really good at invoice automation, we're very good at compliance. We're very good at connecting to workflow and ERPs, making sure that invoices flow through with the lights out, if you wish. We know that there is also a specialism around electronic invoicing. There's a specialism around connecting to governments. And together with our partner Sophos, which is a tax automation company, we achieve a very broad, very strong compliance footprint in about 140 countries, where Sophos very specifically looks after that connection with governments, making sure that we deliver compliant AR, compliant AP, so inbound and outbound invoices, where we look after what we are very good at, basically invoice automation. We also realize that we need other capabilities with regards to tax determination. How do you define the right tax treatment? That can be very different for different countries. We cover 195 countries with our partner Sophos there. And then also all the filing and analytics that need to be done is also very important. So together we built that unicorn. Each of us individually is not, but together we can build everything that you need to deal with all that, what I showed you earlier, all the changes, all the upcoming mandates. And secondly, you deal with the automation perspective, where you allow yourself to grow your company and create more value. That is a marriage of two different universes: the marriage of compliance and the marriage of efficiency together, or if you wish, survival and existence together, because that is what you need. Now, I've come to the end of my webinar for today. I want to thank all of you for your time, your attention. I hope this was useful. I realize that there may be many questions about deeper requirements in specific countries. The countries I showed to you are countries we cover. We can help you in. If you have questions about these countries, please reach out. You can also, of course, raise the question here if you want us to contact you about any specific countries or any countries that we didn't cover today, because, of course, you will realize that time was limited today. And if we wanted to do every country in great detail, we would have been here for quite a while. But we're very happy to help you further with other questions. Please send us your questions. If we can't answer them today, we will take them away and answer them separately.